Good afternoon. This week, the largest technology companies on Earth lost $797 billion of value in a single day, and the reason was not that anything went wrong with their business. Alphabet grew revenue 24%, its cloud division grew 82%, and its free cash flow went negative $5.9 billion in the red, the first quarterly outflow in nearly 2 decades, because it is now spending up to $205 billion a year building artificial intelligence capacity. That is the story everybody covered. Here is the story almost nobody connected to it. In the same week, the odds that the Federal Reserve raises interest rates in September went from under 53% to 82%. The entire artificial intelligence build-out was underwritten by 2 things: enormous free cash flow and a falling cost of money. This week, both of them stopped being true at the same time. Let's take it in order. Here is the board, and the spread between these numbers is the whole story. The S&P 500 closed Friday at 7,411, up less than 4 points, essentially flat. The Nasdaq Composite fell 0.6%. The Dow rose 0.5%. All three finished the week lower. Brent crude settled near $97 after falling about 4% on Friday, its biggest single-day drop since late June. Bitcoin sat around 64,000 with a fear and greed reading of 27, which is outright fear. And the 10-year Treasury yield is 4.69%, with the dollar index at 101.47. Gold is around $4,028, defending the 4,000 line against a firmer dollar and higher yields. Now hold on to the one number underneath all of that. On Thursday, the 7 largest technology companies lost $797 billion in one session, the worst day for that group since the tariff shock of April 2025. And the index barely moved. An index that goes nowhere while its biggest members fall is an index whose breadth is quietly improving. That is not a crash. That is a handoff. The signature segment, consensus versus the read. First, and this is the one that reprices everything else. The consensus says the Federal Reserve's next move is a cut. The tape says the next move is priced as an increase. Futures now put roughly 82% odds on a rate hike at the September meeting. 1 week earlier, that number was under 53%, even for next week's meeting, where a hold is still expected at 3.5 to 3.75%. About 1 in 3 is pricing an increase. Here is the mechanism. June's beautiful inflation print, 3.5%, down from 4.2%, was bought almost entirely with a 5.7% collapse in energy prices in a single month. Core inflation, the part that tells you about the underlying economy, was flat on the month at 2.6%. Then Brent crude went to $100 on Iran. You cannot spend the same disinflation twice. And a new Federal Reserve chair who keeps saying prices are too high will be judged on the headline number, not the core one. High conviction on the direction of risk. Lower conviction on the September meeting itself, which is one oil slide away from repricing. Second, the consensus says the artificial intelligence sell-off is a dip to buy. The tell says what changed was not the mood. It was the funding model. Alphabet's free cash flow came in at negative $5.9 billion, the first quarterly outflow in nearly 20 years, on $44.9 billion of capital spending in one quarter, with full-year guidance lifted to between $195 and $205 billion. And the revenue was fine. $119.8 billion, up 24%, a beat, with cloud up 82%. That is exactly the point. This was not a demand miss. This was the moment the market noticed that the largest construction project in corporate history has stopped being paid for out of operating cash and started being paid for out of the balance sheet. At precisely the moment the cost of that money is being repriced upward. A dip buying thesis assumes the inputs are unchanged and only sentiment moved. Both inputs moved. High conviction. Third, the consensus says fear about artificial intelligence spending means you sell semiconductors. The tell is that in the very same week, the supplier printed its best quarter in 15 years. Intel reported revenue of $16.13 billion, up 25.4%, the fastest growth since 2011, beating estimates by nearly 12%. Its data center and artificial intelligence revenue grew 59%. Earnings came in at 42 cents against 22 expected, and that was the 7th straight quarter it has beaten its own guidance. Here is why both things are true at once. Capital spending is an expense on the spender's income statement and revenue on the suppliers. When the market punishes the check writers, the money does not leave the theme. It moves down the stack to whoever cashes the checks. Medium to high conviction. This is a rotation call, and rotations are very easy to be early on. Follow the money. Rates and inflation are the load-bearing wall this week, and the wall moved. June's consumer price index landed at 3.5% annually, the first decline in 5 months and a genuine downside surprise against a 3.8% forecast. But read the composition. The monthly print was negative 0.4%, the largest single-month drop since April 2020. And the energy index fell 5.7% in that 1 month. Core inflation was flat on the month and 2.6% annualized. Strip out energy and you have an economy sitting at roughly target, not one in disinflation. Then July happened, 13 consecutive nights of American strikes on Iran, Houthi attacks on 2 Saudi tankers in the Red Sea, disrupted traffic through the Strait of Hormuz. The exact input that manufactured June's good number went into reverse, and rate futures noticed long before equities did. The Federal Reserve itself is the wild card, deliberately so. This chair has stepped back from explicit forward guidance, which means the market has to price the reaction function rather than simply read it. A chair on record that prices are too high, inheriting an oil shock, with core behaving but headline about to be reinflated by energy, is exactly the setup where an increase becomes defensible. Friday offered some relief. Brent fell about 4% to settle near $97, its biggest one-day drop since late June, as traders digested conflicting reports on stalled talks between the United States and Iran. One session does not unwind a regime, but it does show you what this whole complex is now hostage to. The dollar and gold are telling the same story from opposite ends. The dollar index at 101.47 and the 10-year at 4.69% are both consistent with a market that has stopped expecting easing. Gold at roughly $4,028 is defending the 4,000 line rather than pressing new ground, because a firmer dollar and higher real yields are a headwind for an asset that pays you nothing. That it is holding up this well against those two headwinds is its own signal about what people want to own into a geopolitical tape. A word on positioning and sentiment drawn from market and social sentiment monitoring rather than any single source. The commentary split this week was unusually clean. On one side, the view that Thursday was a healthy flush and that anything with an artificial intelligence order book is now cheaper for no fundamental reason. On the other, much smaller group pointing at the free cash flow line and asking who funds the next $200 billion if the cost of money is going up rather than down. What is notable is that the second argument barely existed a month ago. The mood on capital spending has shifted from treating it as a growth signal to treating it as a claim on cash, and that shift happened faster than any of the underlying data changed. In crypto, sentiment is doing something genuinely interesting by doing nothing at all. Bitcoin sat around $64,000 through an $800 billion technology drawdown, with fear and greed at 27 and roughly $225 million of exchange-traded fund outflows. The correlation everyone assumed that Bitcoin is simply a leveraged Nasdaq did not show up this week. That is either the beginning of a real decoupling or a lagged reaction that arrives Monday. We are genuinely guessing on that one. Now the tell, the single most revealing number this week is not $797 billion. It is a pair of numbers, 3.5% and 82%. On July 14th, June inflation printed at 3.5%, and the market read it as the end of the inflation problem. The energy index had fallen 5.7% in a month, the biggest monthly drop since April 2020, and core was flat. 9 days later, with Brent crude at $100, the probability of a September rate increase stood at 82%, up from under 53 a week earlier. The disinflation was not structural. It was a rebate from the oil market, and the oil market has asked for it back. Everything else in this issue, the spending repricing, negative free cash flow suddenly mattering, gold pinned at 4,000, the Dow beating the Nasdaq, all of it is downstream of that single reversal. Sectors in play, semiconductors. The bull case is that Intel just grew 25.4% with data center up 59% and beat by nearly 12%. The artificial intelligence order book is real and it is landing on suppliers right now. The bear case is that if the large spenders are now funding this from the balance sheet rather than from cash flow, then the 2027 order book is a financing question rather than a demand question. The read. The supply side is being paid today out of budgets set when money was cheaper. Enjoy the print, watch the 2027 guidance. Megacap platforms, revenue up 24% and cloud up 82% says nothing about demand is broken. Free cash flow negative for the first time in nearly 20 years, with spending guidance revised up rather than down, says these are becoming capital-intensive infrastructure businesses still wearing software valuations. That is a re-rating question, and it does not resolve in a week. Energy. Hormuz risk is live, 13 straight nights of strikes, tankers hit in the Red Sea, and yet Brent fell 4% in one session on a diplomatic rumor. Oil is currently the most important macro asset in the world because oil is the input to the Federal Reserve's decision. On the radar, next Tuesday and Wednesday, the Federal Reserve decision. A hold at 3.5 to 3.75% is consensus, with about 1 in 3 pricing an increase even there. But the real event is the statement language, because that sets the September path currently trading at 82%. Ongoing, the Strait of Hormuz. Brent above $100 makes September nearly certain. Brent below 90 kills the increase entirely. Early August. July's inflation report. That is the first print that contains the oil shock, and it is where the borrowed disinflation gets settled. And ongoing, the capital spending guides from the other large platforms. Alphabet set the marker at $195 to $205 billion. Whether its peers follow it or blink determines whether this is a Google problem or a sector problem. The scorecard, 3 new falsifiable calls dated July 25th. 1. By the September meeting, the Federal Reserve does not cut. That is falsified by any cut at or before September. Confidence high. 2. At least one other large platform company guides 2026 capital spending above $150 billion before third quarter earnings close. Falsified if none of them do. Confidence medium. 3. Alphabet's free cash flow returns to positive within 2 quarters, meaning this negative print is a timing artifact of capacity delivery rather than a permanent state. That is falsified by a third consecutive negative quarter. Confidence medium. No prior calls came due this session. The close. For 3 years, we are spending more on artificial intelligence was the single most reliable way for a large technology company to make its stock go up. On Thursday, the companies that said it loudest lost $797 billion between them, and the one that said it with the biggest number, $205 billion, funded partly from the balance sheet for the first time in 20 years, fell the hardest. Nothing about demand got worse this week. Alphabet's cloud business grew 82%. Intel's data center revenue grew 59%. The demand is there. What changed is the price of the money that pays for it, and who carries the risk of the build. So here is the question worth sitting with. Is the market finally asking the right question about artificial intelligence spending? Who actually earns a return on all this? Or is it just having a rate tantrum with a technology logo on it? We will know in about 10 days. And it will be an oil price that tells us. This is the asymmetric signal, 1 contrarian read a day. Subscribe, research and educational only, not financial advice.